morning and welcome to this week's Market Carver. I hope you had a wonderful 4th of July. Great weather, at least around the Anderson area. Happy to see that. With all of the discussion of Greece and everything else, let's start off with some fun stuff because the world clearly has changed. Uber is the largest taxi cab company in the world and owns no vehicles. Facebook is the largest distributor of content in the world and produces no content. Alibaba is the largest retailer and has no inventory. And Airbnb is the largest accommodations place and owns no hotels. So the world has truly changed in a lot of different ways. And as we go through this today, that is an important conversation to keep in mind. Things do change. Well, as you know, Greece defaulted on their debt, did not pay the money back so far. And interestingly enough, the election that was the vote that was taking place over the weekend, everybody believed the Greece people were going to vote to take the deal from the IMF. So much so that one of the places that you can go online and make a wager to bet to say, hey, whether you think they are or aren't, 3 days before the actual vote, they actually paid out the winners to the wrong party. One of our friends compared it to the Dewey Beats Truman article that came out in the newspaper obviously years ago. One of the biggest upsets that ever occurred, at least according to the paper people. We do have shocks to the system that we have to be prepared to deal with. And the slide you're going to be able to see is complex. It's hard to read. There's a lot of gibberish on there. But what you're seeing is even with the Lehman, the crash in '87, the JFK assassination, on average, the market returns back to normal in about 14 days when there's a problem of volatility. And the average loss is about a 5.3% return. So we do look at Greece. We are concerned about Greece. The biggest issue that Adam and myself are looking at from the allocation team is what happens if the banks are not able to use that debt as collateral. That's when some of this stuff could really be interesting. It's why the big banks all met this week. And the Germans and in Europe trying to figure out precisely what it is they're going to do. Now, I want to move real quick into the economic world. The unemployment numbers came out. They're down to 5.3%. Everybody seemed to be a little excited about that. But what we fail to forget is the labor participation rate is continuing to decline. Now, as Andrew would remind you from a market perspective, that hasn't hurt the market. The labor participation rate's been going down since about 2007, and yet the market obviously has recovered from 2008 and doing quite well. It is a long-term structural challenge that we have, though. There are less and less of us that are in the working force, and with 10,000 people a day turning age 65, it could be a problem. Now, Deutsche Bank did a report over the weekend of the S&P 500 companies, and I found this unusual. There are now 502 companies in the S&P 500, which I've never seen the number be above 500 before, so I thought that was interesting. But their analysts believe that 94% of all of the earnings in the S&P 500 this year will go to share buybacks and to dividend payments. Now, that may sound good on one side, it may even drive the market higher, but what it does mean is companies are not investing in their future to have more growth and to have a better business 10 years from now. That is a concerning issue, one we have to watch closely. Hey, if you're out and about on Saturday morning, don't forget to catch the radio show 9 to 10 on WQME, 10 to 11 on Shine 99 on Sunday mornings, and Thursday afternoon from 4 to 5 p.m. on WILO. If there's anything we can do to be of service, please don't hesitate to let us know. God bless, have a great week. We'll see you again soon.